Let's take a moment to examine how pension funds invest their money. Before we do that, it's important to note that the time horizon for pension plans is technically infinite. They are designed to be sustainable over the life of the organization they represent. Anyone who's lucky enough to have a defined benefit pension plan that is sponsored by an employer is truly fortunate because defined benefit plans absorb the risk of market fluctuation. For over a generation now, the trend has been toward virtually all non-government pensions moving toward a defined contribution format. Many people note that the two options are different primarily based on who absorbs the risk, but there's a second important feature that is often overlooked: the universe of investment options within the plan itself. Defined benefit plans make extensive use of private assets and alternatives, while defined contribution plans tend to stick to the more tried and true options that are common with retail investors, mostly things like stocks and bonds. At this point, it's important to note that neither approach is obviously better. Instead, I would simply say that there are important details that you should be aware of. That's especially true if you're looking to commute your pension if you leave your employer. There are a few things that pensions do differently compared to most retail investors. First, the defined benefit plans often have a much wider product shelf to choose from. They often invest in things like private equity, private infrastructure, private debt, and private real estate. Most retail investors have little and often no exposure to private assets. 2. The defined contribution plans are often the exact opposite when it comes to product choices for portfolio construction. Many defined contribution plans partner with a single company as the provider of all investment options. Not only does that constrain the universe of products, it also often confines investors to a particular worldview. In addition, many companies that have a monopoly in providing DC plans feature products that are relatively expensive. If nothing else, other providers might offer a nearly identical product that's 50 to 100 basis points cheaper. Unfortunately, you won't be able to use those products because you can only use the products offered by the plan's provider of choice. Third, the risk-return trade-off involved in any portfolio depends on the range and covariance of investment options available. Once again, DC plan options are often the same as what you might see in a conventional portfolio, mostly stocks and bonds. Adding alternatives should, in theory at least, allow for a better risk-adjusted return, if only because the universe of building blocks is larger. Let's be a little more precise there. According to a quick AI search, most pension plans have between 18% and 40% in alternatives. The midpoint is 29%. A similar search asking about the allocation to alternatives in retail portfolios reveals that the typical investor has only 1% to 3% in alternatives. Let's split the difference and call it 2%. In other words, a typical pension plan, and it should be noted that they are at least always somewhat different, has more than a quarter of its holdings in alternative assets, while most investors have either no exposure at all or very little exposure. What are the pros and cons of each? Well, one thing that many investors find comforting about defined contribution plans is that they're broadly familiar with the value propositions of the products they can choose from. Tell someone they can invest in Canadian large cap companies, and they'll understand what that means. Similarly, if you tell people that they have an option of buying corporate bonds, they'll understand the broad expectations they should have if they go through with an allocation. The second thing that differentiates pension options from most retail options is that private offerings available in pension plans are often illiquid, meaning they can't be sold and converted to cash quickly and easily. Many underlying holdings that are private in nature require at least 90 days notice before you can get access to your money, and in some instances, it takes longer still. That's of major concern to some people and of virtually no concern to others. I'm not here to tell you whether you ought to be concerned or not. I'm simply pointing out that there are differences that you should be aware of. One of the reasons so few people have private assets in their portfolios is that they often are only available to so-called accredited investors. Those are people who are deemed to be more sophisticated by regulators. Unless you have a strong income, a high net worth, or work with a portfolio manager, it's unlikely you'll be able to access private assets in your retail accounts, even if you desperately wanted to. So in conclusion, I've often said that investors in general and retirees in particular should take a pension-style approach to investing. From my perspective, the ability to access a wide range of product offerings, both asset classes and strategies, can clearly improve the prospects for better risk-adjusted returns. If you're lucky enough to have a defined benefit pension plan already, the need is less acute because some of your retirement will be coming through the purposeful use of alternatives. If, on the other hand, you don't have a pension plan or you only have a defined contribution plan, your investable universe is smaller and your risk-adjusted returns may suffer as a consequence.